Hello friends, and welcome once again to your channel, The Smart Investor. In today's video we are going to be analyzing 3 companies with large market capitalization that are falling quite strongly after their earnings report. In each of these companies we are going to review their fair value or intrinsic value, the current evaluations and growth expectations for the next 5 years, and then from the technical point of view, we are going to see the purchase zones that I have marked in each of them. Let's also take a quick look at how their earnings report went to see why companies are falling. Let's begin. We start with Broadcom. Broadcom is one of the largest companies in the world, and in addition to that it is one of the main companies in the semiconductor sector. We see here that the market capitalization of the company is more than $650 billion. However, we see that the shares are falling more than 3 after their earnings report. Furthermore, the company has been looking expensive. It's 50% above its fair value or intrinsic value. This is also reflected in the valuations. We see here, price to earnings ratio higher than 40. Remember that price to earnings compares the company's earnings with the share price. With this price to earnings ratio of 40, the company is now 18 above its historical price to earnings ratio of the last 5 years. And also the price to sell, that compares the sales with the share price, it is 60 above its historical valuations. Currently, Broadcom seems costly. It is true that the company is expected to continue growing at a very rapid pace. We are talking about the fact that over the next 5 years, it is expected to grow at a rate of 15 in sales, 14 in profits and almost 20 in cash flow. But with this growth the current valuations are not justified. In fact, if we look at the company's earnings report, it was quite solid. We see here that it exceeded expectations in revenues and profits, and in terms of revenues, it reported an increase of more than 34% year-over-year. Something also quite interesting is that it is expected that next year it will generate some $50 billion in revenues, more or less in line with what was expected, and in addition to that they have an EBITDA margin of around 60%. Because I found this interesting, because if we see the company was managing a growing EBITDA margin, look here how it has been increasing it. Year after year, only in this last fiscal year it was 58%, and it is expected to increase to 60%, so the truth is that the company is having very healthy growth. So, based on all these numbers the company, I would like to see it much closer to its FBA, much closer to 800, maybe the 200 period moving average is an interesting buying zone. But with current valuations historically, the company is too expensive. Even with this drop I think we have no chance of purchasing here for the moment. Let's move on to the next company. Next company, Costco. We see that the shares are falling more than 4-fold after their earnings report. This is another gigantic company, market capitalization above $300 billion, but very expensive. We see here that the super value or intrinsic value is 150 below the share price. We can see that it is quite impressive. We can see that this is a discount store company, a business quite similar to Walmart, although you have to pay a membership to access their stores, and the most impressive thing is that the company is trading at a price to earnings ratio of 53. We are talking about a 55 above its sector and a 27 above its historical evaluations. And we also see that the rest of the evaluation metrics, price to book, price to sell, price to cut flow, all of them are worse than their 5-year average. So the cheap company is not there. Furthermore, if we look at the growth, Costco is only expected to grow its profits at a rate of approximately 9 per year, which of course does not justify these extremely high valuations that we are seeing in the company. The earnings report was also mixed. We see here that they narrowly beat earnings estimates and missed revenue expectations by about $700 million. If we look at it from a technical point of view, the stock is very overbought. It is at all-time highs. We see here that this is a company that came with a fairly predictable trend in the past. However, it skyrocketed starting with 2023, and right now, that is why we see it so extremely expensive. It is also quite interesting in the 2022, with the correction that we saw in the stock market, the company corrected approximately 133. If now we see a correction of the 33% of the stocks we are talking about, that we could see it at values close to $500, that I think that from $500 perhaps it would be a reasonable investment. I would have to want a lot. Maybe we could buy a little at the moving average of 200 periods. But at these prices and these valuations, The truth is that I believe that it is very risky to enter Costco, even with this drop after the earnings report. Let's move on to the next company. If you like the content on our channel, remember that you can subscribe to it and hit the notification bell to never miss our videos. You can also leave a comment. I always respond to 100% of the comments you leave me, and I'm interested to know what you think about the companies we are analyzing. You can also leave a like and share the video so that it reaches more people. And the last company that I bring you in today's video, Marvell Technology. This is a company that is also in the semiconductor sector, quite large, market capitalization of $73 billion, and we see that the company also looked expensive. Approximately $139 above its fair value or intrinsic value. The shares fell more than an 8 after the earnings report that we will review in a moment. This is a company that, if we see here, has not been able to generate profits during the last 4 fiscal quarters, and on top of that is trading at a price to sell price of 13, that is a 40, above its historical valuations. We can see here that the company for 2024 is expecting a big drop in earnings per share, but a big recovery from 2025. If we see the earnings report, it was quite bad. It exceeded expectations in revenue, but still it was revenue growth of just 0.7 annually, and profits came in line with expectations. The main problem we have is that the company was previously expected to generate $13 billion in revenue in the first quarter of 2025, and the company finished its fiscal year 2024, and now they said they were going to make approximately $11 like this, which are about $200 million below what was expected. Also, with this $1 billion that the company is expected to generate, if we see its previous earnings reports, we are going to put here quarterly. Remember that we are in our investment tool, the Smart Investor tool. We see that during the first fiscal quarter of the year 2024 generated $13 billion, and now, a year later, $1 billion is expected. So a pretty significant drop in revenue year over year. From a technical point of view, it must be said that the stock was already coming from an overbought zone. We see here both the RSI and the MACD that were very overbought. So the company had to make a very good earnings report to maintain these values, and we already see that it did not do so. Personally, I am not clear about an investment in this company. We have the semiconductor sector very hot. We are expecting a correction in this sector at any time, and the truth is that Marvell Technologies is not one of my favorites in this sector. However, if we see it below $50, perhaps this entire area that we saw here below the fair value could be an interesting technical entry, perhaps for a swing trade, but as I said, it is not my favorite company of this kind sector. It will have to fall at least close to $50 to be a buying opportunity. Let's go to the end of the video. As we could see in today's video, friends, I think that these 3 companies are generally quite good companies, and in the case of Broadcom and Costco, especially, they are businesses that attract a lot of attention to me. Furthermore, the company's earnings reports were not bad. The companies are simply very overbought, and that is why we saw this drop of more than 4. In the case of Marvell Technology, the semiconductor company, I don't really like the company's numbers. Not much growth is expected for 2024-2025, and also the company was also technically and fundamentally not in the buys. In the case of Marvell Technologies, it was quite bad earnings reports, mainly because they significantly decreased their revenue guidance for the next fiscal quarter. So I would be patient. Maybe in the 50 area Marvell Technologies can be a buying opportunity. Please remember that all content we see on our channel is for educational purposes, as I am not a financial advisor. If you like the content, you can subscribe, activate notifications, you can also leave a like and share the video so that it helps more people, and also leave a comment. I always invite you to review the description of each of the videos on the channel. In the first link I leave you our investment tool, the Smart Investor tool. Where we saw the numbers of the companies today, we use this tool for fundamental analysis. Thank you very much and see you in the next video.